Welcome. It's a Saturday morning when we don't normally do calls very often, but I'm bringing on somebody who's very, very busy, and this is what we can make work. So I congratulate you for all showing up on a Saturday with your puppies in some cases, and some of you, your mascot. Are you driving too? Matt, Michael's driving. Everybody's driving. I see a steering wheel. You have that background. Anyway, don't get it. No accidents allowed, please. So today I get to welcome somebody who's become a really good friend of mine and somebody I'm just really proud of. He was one of my very, very first students many years ago when he was, I think he was still a student learning geology. And I guess he learned early on that he'd rather do real estate than geology. And I had the pleasure of teaching him way back when I used to do trainings in Las Vegas. I used to show people how they can make money at the auctions there. And he's also done numerous different trainings of mine. And the thing I love about Cal is that if I teach him something, he not only applies it, but then he goes and adds to it. Like he says, well, Mike, that all worked great, but then I did this and this got even more results. So I always love to have Cal on the show because he always brings a lot of actionable content and wisdom, because he actually goes and does it. And then he just keeps going deeper and deeper and deeper into the topic. So I've had him numerous times and he's one of our coaches, but today he's here to talk about notes, which I've never had him speak on before, but I know he's doing a lot of them because every time I look, I get another email saying, hey, we just took down another note. So Cal, welcome to the show.
Hey, Mike, glad to be here. It's been
Good to have you again. It's been a little while. I know you're always busy I know you got your kids and baseball. I know you're coaching and all that good stuff. And somehow you managed to do lots of deals in between all that. So congrats.
Yeah, not much sleeping, I guess is
who needs it? Overrated.
Yeah, but no, it's good to be in front of the wolf pack again. It's been quite a while, so good to see some familiar faces. And I'm sure some of you guys watching the recording, it's good to get in front of everybody. I hope all of you are learning a lot and applying it and making some big changes to your lives and reaching your goals. I know I've seen some of the posts that some of you all have posted, some of your successes and deals you've done just from these kinds of trainings. So it's just so awesome to see some of the people that were in my first wholesale training growing and doing deals and just applying. It's really awesome. So anyways, I'm happy to be here, Mike.
Great to have you. And I'm going to mute myself, but I'll be, of course, hanging out in the back.
Oh, you're muted too soon.
I'm ahead of my time. Yeah. So the stage is all yours. If you need to share, go ahead. And looking forward to hearing what you have to teach.
Yeah, sure. So I have gotten into investing in mortgage notes in the past couple of years, and it's a bit of a progression. As Mike said, I've talked about a lot of different topics in front of the wolf pack and some of Mike's other students down in Houston and that kind of thing. And my whole journey has really been a progression. Since I met Mike, that was really the start of my investing career. I had just taken some Rich Dad, Poor Dad courses and found that some of the things I learned didn't apply here in Canada where I live. And that's when I met Mike. And Mike just happened to be a fellow Calgarian investing in the US. And I found that really interesting. And so Mike really got my investing journey started. And it's just been a cool path that I've taken. It's really been a windy path. I've tried a lot of different strategies. I think for me, I love learning. I love being a student, and I like trying different things, seeing if I can make them work. And so some things haven't worked so well. Some things work better than others. And being in Calgary, working remotely as a real estate investor, I think some strategies are more difficult to apply remotely than others. And so I've tried a lot. And I've been able to gather a lot of different experiences that have helped me in my career. So one thing I've gotten into in the last few years is investing in mortgage notes. And that kind of started from doing some owner financing. So I would buy some deals down in Texas. And I had some opportunities when I was talking to motivated sellers originally where I could actually do a subject to deal, take over their mortgage payments, and then turn around and sell the house or sell the house again with creating a note and owner finance it to a new borrower. And I did a couple of those types of deals. I'm sure, Mike, you've had some people talk about subject to. And so I did a couple of those. I had some other deals where I just needed to owner finance the property. And so I like the idea of being the bank and just collecting monthly rent or monthly interest, principal and interest payments as a lender instead of a property owner. And there's definitely, positives and negatives to all the different strategies. And I know, Mike, you're a big rental property guy for sure. And there's tons of benefits to owning rental properties, especially with your strategy, Mike, where you like to buy in places that are also going to appreciate. But one of the things with rentals that everyone wants is monthly cash flow, not just appreciation, or most people anyways. And one thing I like about mortgage notes is you can set them up kind of two different ways, but we're going to talk about the performing mortgage note where the borrower is paying every month. And it's a great source of cash flow without some of the headaches that come with being a landlord and owning rental properties. So I have had rental properties. I have a couple still. And as many of you probably know, you've got to deal with tenants and, sometimes they wreck the property, sometimes they don't pay the rent and you got to evict. So there's a lot of headaches that come with being a landlord, and that's just par for the course that come with a lot of the benefits. But what I found with mortgage notes is when you're the lender, and if any of you guys have a mortgage on your own house, you don't have, Wells Fargo or whatever your lender is coming and helping you fix your toilet, right? So if your toilet breaks down, you're on your own. You can't call your mortgage company or your lender and say, hey, come fix my toilet, right? And so that's the great thing about being a note holder is you become the bank, you own the mortgage that they are paying you every month, they owe you the balance, and you don't have to worry about all the maintenance. You don't have to worry about a lot of the drama. There's no evictions. You don't have to find new tenants every year or so, worry about increasing rent and all of that. So I like that as a passive investment. Once you get the deal going, it's kind of a hands-off investment and there's great cash flow. So I can have different notes paying me month after month, and I don't really have to worry about it. I don't have to do a lot once I've got the note purchased, and I'll kind of explain a little bit more what those kind of deals look like. So that's how I got into notes, and I thought it'd be cool to share a case study of two notes I bought earlier this year down in Laredo, Texas. And I actually was trying to buy 4 notes from the same seller, but I only ended up having the capital to take down 2 of them. But I'm going to share with you these notes and just kind of how the deal turned out, what the numbers can look like for you if you were to buy a performing note. And then we can take questions, and I'm happy to kind of take the conversation any way you guys want if you've got questions. So I'm just going to share my screen here. And I'm going to try using Canva. I've never done a presentation in Canva before, but my VA created this presentation. So I'm going to see how it works. I'm going to present instead of PowerPoint. Present full screen. Okay, can you guys see my presentation?
Yeah, perfectly. Looks great.
Awesome. Okay. So they're not pretty, these two properties. They're both very similar deals. And the background on this is there's an investor. This is pretty common in Texas. I found a lot is there's a lot of real estate investors that what they do is they will look for vacant lots or properties that can be torn down, and they'll buy the lot, and then they'll either they'll move on like a manufactured home or a mobile home onto the lot, or maybe they'll just rent out the house that's on there, get it livable again. And then what they'll do is they'll actually owner finance that property to somebody that can't quite qualify for a mortgage. So maybe they have poor credit, or they're new to the country, maybe they're self-employed, and so they just can't qualify yet for a bank, a traditional lender. And so they'll owner finance the property, sell it to them. So this new buyer now owns the property, and they have a mortgage with that investor. And so there's a mortgage note's been created, and they're paying the investor. But what the investor then does, instead of keeping that note, he or she will sell it to someone like myself who wants to buy notes. And then they'll take that money and they'll go and buy another lot and do the same thing. And they'll keep repeating. That's their investment strategy. And so I encountered a gentleman like this. This is his business down in Laredo. And he sold 4 of these at one time. He does a lot of them. And so in this case, he has these lots and he moves these relatively new manufactured homes on, and you can see that's what this is here. And so basically I bought the note turnkey. The borrower was already vetted, already paying, they own the property already. and they'd already shown, well, 3 to 6 months of payment history showing that they were making their payments. And that's when I took over and bought the note. So these are what the numbers looked like. And feel free, if you guys want to ask questions, just go ahead at any time. All right. So as I said, it's manufactured home on a lot. So every note I buy, I always get a broker price opinion to see what the value of the actual property is. Okay. And so I had a realtor do a BPO, which is similar to a CMA, comparative market analysis, but they look a little bit more at the condition of the property itself as well, instead of just recent sales. So they factor that in a bit, just based on what they can see from the outside. And so this property is valued at $100,000. And so these are the details of the original mortgage note. So this is what the current owner, when they bought the property with owner financing, this is the mortgage that was created. So they originally owed the investor $70,800. That was their loan amount. Okay. They originated this mortgage just recently in October of 2022. So it's a fairly new mortgage, and it's a 30-year mortgage, which I really like. So you've got a lot of time where you can collect a lot of cash flow. And the great thing about amortized mortgages is that the first couple of years, the borrower is mainly paying interest. Okay. As you get later on in the age of the mortgage, you're mostly paying principal down, which to me is a little bit less desirable. So that was a plus, is that it's a really new note. But I do like the fact that there's a few months of history showing that the borrowers can actually afford to make their payments and that they haven't missed any or been late on any payments. So that's what I do like to see. And because this is an owner finance note, it's pretty common to see high interest rates. And the reason for that is this investor is helping someone that wants to be a homeowner get a mortgage when they normally wouldn't be able to. And so they're paying a bit of a premium for that because they can't go down to the Bank of America or whatever and get a mortgage. Okay. So they're going to be paying a higher rate because this investor is financing for them. Okay. So that's really desirable from my perspective, was a 12% mortgage interest rate. And so their payment is $728.26 a month. Okay. So that's the original loan when I bought it. That's what it was looking like. But I didn't pay par for this note. So par would be paying the same amount that the borrower owes on the note, me buying that note for the same amount. And if I were to do that, if I were to pay par, then I'd be getting the 12% return. Okay. Which is nice on this note. 12% return on your money is great, right? A lot of people would like that. But in this case, I was able to get an even higher return because I actually bought this note at a discount. Okay. So when I bought the note, the borrower still owed $70,718 on it. And it's because it's brand new, right? They barely paid any principal down at all. And so I bought it for $50,000. So what happens there is the borrower owes me $70,700, but I only paid $50,000, right? So instead of a 12% return on my money based on the principal and interest payments coming every month, that increased it because I'm paying $50,000 for this mortgage. I'm getting 17.5% return on this deal. Okay. So that's the benefit of buying at a discount, is you're basically buying at an IOU at a price way lower than what is owed. Okay. So someday that borrower is going to have to pay me out, and they're going to owe me a lot more than was invested. Okay. And let's just say that tomorrow they sell the house and pay it off. Well, then the difference there between what they owe and what was paid to buy the note is like $19,000. So there's some equity created there if they were to pay it off at some point in the future. Michael, don't crash, but feel free to ask your question.
Why would the original mortgage holder want to sell it to you at such a discount?
That's just his business model. So he factors in that note buyers like myself are looking for discounted notes. Most investors, like note investors, want to buy at a discount. There's some like hedge funds and things like that can pay par, but most note investors are looking for some equity there. And so that's his business model is he buys them for cheap, puts the properties on there, owner finances them, collects a down payment, and then sells the note, gets a big chunk of his money back. And then he can keep doing that rinse and repeat kind of a model.
So are you taking advantage then of the time value of money idea where instead of him having to wait 30 years to get all his money, he gets a lesser amount, but he gets it right away? Is that why he's willing to give you the discount?
Exactly. Yeah. Yep. So then
All
he
right,
can take
makes
that
sense.
money and keep it going and do more of these, and he can scale his business. Yeah. And who knows, maybe he keeps some of them for himself for cash flow as well. You know, maybe he's only selling because he needs some cash to do whatever he needs. Like there's a lot of times where you'll see note sellers, they've got other deals that they want to do. I was talking to a guy in Texas where he had some nice notes he was selling because he wanted to buy an apartment complex. And so he was willing to sell off his notes at a discount so he can get the cash he needed to close that deal. So that kind of thing's pretty common. Yeah.
Thanks.
Yeah, no problem. Yeah. So, and then the equity. So let's go back to the property value. So the value of the house is 100,000. Okay. Now, because I'm the lender, I'm the note holder, the value, I don't really ever see that 100,000 unless I were to maybe foreclose, if I had to foreclose. So that 100,000 doesn't matter a lot to me. I'm not really going to get that equity typically, but why it's important to me is because I have equity as a security. So if I were to ever have to foreclose on that borrower, if they were to stop paying, I know that if I have to sell it at the foreclosure auction, if the house is worth 100,000, probably an investor is going to buy it maybe a little bit at a discount at the foreclosure auction. But I know that me getting my 50,000 back is pretty much a sure bet, right? Because if $100,000 house, if I foreclose, I'm definitely getting my 50,000. I'm probably going to be able to get my 70,000 that's actually owed on the note. And so that's where the purchase price matters, or sorry, the property value matters, is because that's securing me, making sure that I can recover my investment if the borrower were to stop paying and we had to go into foreclosure. Okay. So a lot of times real estate investors who, and this was I had to kind of shift my mind. We're so used to property values and thinking of like fix and flips and rentals and stuff. But from a note buying perspective, we're more focused on the amount owing on the note because the property value, we're not going to ever get that equity unless we had, foreclosed and took the property back. So, but there is $50,000 in equity there as a security blanket for this investment, which is nice. I can sleep at night knowing that. Okay. And so what I ended up doing with this note is I actually brought in a funding partner who paid the purchase price, paid for the purchase price of the note. Okay. So I have a private lender on this deal. And so I was able to borrow $50,800 from them. 50,000 for the purchase price and 800 for some of the closing costs and due diligence. Okay. And so I have a funding agreement with them. I pay them 8% on their money. And so they're getting a nice return. They're happy with their return on investment. And I'm making a nice monthly cash flow on that. And so they're getting part of the monthly principal and interest payment paid to them as interest on their loan for this deal. And I'm getting part of that cash flow for me every month coming in. So that's how I was able to fund this deal. And the other one I'm going to show you, which is very similar, is actually bringing in a partner and they put their money in and I'm paying them a nice return. So it's kind of a no money down deal. Hey, Dave.
Hey, Cal, sorry, I just want to circle back and just make sure I grasp the concept of what you're speaking here. So in this case, the unpaid principal balance was $70,718.
Yep.
And you went and you were able to purchase that the note for that mortgage at $50K. So let's say the original lender was, I'm assuming was it a tier one bank or was it just another private investor?
Just a private investor. Yeah.
Okay, so I guess like Matthew's question, which I understand the time value of money, but if he had to lend them $70K to close on the house, where he's taking a $20,000 cut on that, eventually somebody has to come up with that $20K. Where is that in the equation?
between the 70,000 and the 50,000 that I bought it
Yeah,
for.
because if so that guy lent him the homeowner 70K, and if you've purchased the rights to that note at 50, they're
Yeah.
still owed, like he still advanced them 70K, correct?
Well, that's what they owe him, but he paid less for the property. So his money in on that deal is going to be below 50,000. So
Yeah, so I'm going to actually, if you don't mind, I'm actually going to chime in here because I've done a lot of these.
Yeah.
And so you're actually this money this mortgage is appearing out of thin air because he's not actually giving them any money. He's the owner of the property. He's allowing somebody to take it over. When I sell a property to somebody who I know can't qualify for a mortgage, I'm going to charge a premium on that property. So he might be telling them, okay, you can get in with, I don't know, 10,000 down or 5,000 down. And then you're going to owe me, well, if the property's worth 100, the fair market value is 100. There's even a good chance he may have charged them more than 100 because it doesn't have to appraise. And so he's not actually physically giving them any money. He's just creating a mortgage for them, becoming the bank. And actually, let me explain it a different way. Imagine you went to the
No, it's okay, but like the one part of the equation I missed was that the guy that's advancing the mortgage owns the property. Okay, so that makes sense now.
Yeah, he owns a property and he's never actually forwarding any funds to anybody. He's just creating this mortgage out of thin. Yeah.
Okay. Okay, totally get it. Okay, I understand the math now. Thanks.
All right, great.
Yeah. And so that's just one way of doing it. You can buy directly from banks. Typically performing notes from banks, like I was able to buy this one at 71 cents on the dollar. So 71% of the total loan amount. Typically, most lenders and banks, if it's a performing note where the borrower has been paying regularly for a long period of time, you're probably looking more at 80 cents on the dollar to even par. And obviously, most people don't want par, but if the interest rate's high enough, then it might make sense for some investors. But if they're performing, and you can even at 80 cents on the dollar, if the rate's high enough, it depends on what kind of yield you're looking for, but that can be a nice cash flowing return for an investor buying at 80 cents on the dollar from a bank. So there's a lot of opportunity. There's so many lenders out there across the US, and a lot of them will sell notes, and sometimes they'll sell them in pools of notes. Sometimes they'll sell single notes. And then we could go into a conversation about what non-performing notes is, but that's kind of, I would say, another talk for another time because it's a bit of a different strategy. But just from looking for a cash flow without a lot of headaches, buying performing notes can be a really nice investment. And as long as you understand how your security works and the fact that you've got collateral that is worth more than your investment that's protecting you, it can be a nice way to make some nice passive income every month. Okay. So the next one, I'm going to skim through the next one. It's very similar. So I'm not going to go through all the numbers, but I'm just going to show you. So here's another one. Same town, same investor, very similar looking property. And so very similar. The numbers are almost identical. The original loan was 77 and it was started a month earlier in September. Same interest rate, payments a little bit different, but they owed 77 when I bought the loan and I paid 55,000 for it. Okay, so the yield on this one was 17.4% because of the discount that I was able to pay for it. And again, I've got a private investor on this one making 8%. And so I'm going to share a spreadsheet that can show kind of the profit numbers and how they all work, but almost identical deal. And I was able to buy them both at the same time. And this investor actually had 4 of them that he was selling off. So, and this borrower, since I bought the note, none of these borrowers have missed any payments. They haven't been late. And so it's been a nice revenue stream. Okay. So I am going to just, how do I stop, get out of here? If you guys are interested, I can kind of show you what the numbers look like on a spreadsheet, and I might have to zoom in a bit here. There we go. So And this is how I analyze these types of deals. So I always start with the amount that's owing. You guys can see my spreadsheet. Okay. So I always start with the loan balance that's owing on the loan and the value of the property. Those are my two most important numbers. And then what I usually want, I'm interested in what's the lesser of those, because if I have to foreclose, I have to figure how much I'm going to make if we had to foreclose and sell the property. And if the property is worth quite a bit more than the loan amount, then when I foreclose, as a lender, I'm only able to recover the amount owing on the loan. I don't actually get the entire value of the property that it sells for at the auction. I'm only going to be getting what's owed to me on the loan, plus, late penalties and things like that, foreclosure costs. So, and then I'm also looking at equity. So I want to make sure that there's some equity there. And what I mean by equity is the loan amount versus the actual value of the property. I want to make sure that there's some cushion there. But more so what I'm paying. I want to make sure that my purchase price, there's equity between what I'm paying and what the value of the property is, as a way of protecting my investment. Okay. So I'm going to skip some of this stuff, but basically, if I paid $50,000 for this loan or this note, I'm going to have about $500 in closing costs and due diligence costs. And so my purchase price, including those costs to the value of the actual asset, was 50% on the first note and 61% on the second one. So that's where my main equity that's protecting my investment. And that I always want to have something there as a cushion. Okay. So if something goes wrong, I'm going to get my investors' money back or my money back. Okay. The next really important number is the monthly principal and interest payment. And that's going to go into some calculations. I'm going to show you how we actually calculate what the yield would be, or the cash flow, the cash on cash return. So what I do is, when I'm analyzing to see how much I want to pay for a note, so I've got my $50,000 purchase price here. And so what I'll do is I'll take the principal and interest payment and I'll figure out how much that would be in 12 months. So it's just 12 months times the monthly payment. Okay. And so that would be the income from the principal and interest payments in 1 year. Okay. And then I just divide that by my purchase price. And that's how I get my 17% yield. Okay. So again, if you buy it at a discount, you're always going to have a higher yield than the actual interest rate on the note. Okay. If I were to buy it at par, then it's going to be the exact same return as what the interest rate is on the note. Okay. And that's the great thing about it is as long as the interest rate's high enough and you buy it at a steep enough discount, you can achieve the yield that you're looking for that makes sense for you, whatever your comfort zone is for return. Okay. So for me, if I'm using a private lender to fund my deals, I'm going to be paying them between 8 and 10% typically. And so I always factor in, okay, well, if I'm going to be paying my private lender 8%, I still want to be profiting from this deal. And so it typically works out that I need to be getting a yield of somewhere between 14% or higher in order to make it work for my private lender and for me as well to get a nice return. Okay. So in this case, I'm paying my private lender 8% on their money. Okay. And it's interest only. All right. And so in 1 year, I'm having to pay my lender. If I'm borrowing the $50,500 from them at 8%, I'm going to be paying them $4,040 in 1 year. Okay. But in 1 year on principal and interest from the loan that I'm buying, the note that I'm buying, I'm making $8,739. Okay. So in 1 year, I'm paying 4 out of it, but there's going to be like 4 left, right? For me as profit. So I'm paying if you break that down monthly at 8% to my private lender, they're going to get $336 a month. And annually, I'm going to get basically 4,700, and I'm going to be getting $391 a month. Okay. So, I mean, it's nothing to write home about, but if you do enough of these deals, $400 a month, and then do another one for $400 a month, and another one, maybe a couple, you get like $800 a month. You can do quite a few deals like this and have all of your monthly expenses taken care of, right? Just from notes that are paying every month. Okay. And that's what I like about it, is because there's not a lot of headaches once the note's purchased. And I can explain a little bit more about that. I love the fact that now that's coming in every single month to me in cash flow. Okay. And in this case, I didn't put any of my own money in it. If I had funded this deal with my own money, I'd be getting cash flow of $728 a month, and I'd be making 17% on my money. Okay. So that's awesome too. In this case, I just didn't have any cash to deploy into this, but I did have some private lenders. And so I was able to do a no money down deal and make $400 a month. Okay. Now let's talk about a little bit about exit strategies, because this borrower could continue paying on this note for the next 30 years. And that's great. That'd be awesome. But what happens if they stop paying? Okay. So in Texas, especially, I love Texas because it's the fastest state when it comes to foreclosing. You can start, I believe it's like 21 days. If they're 21 days late, you can start the foreclosure process in Texas, and you can have the foreclosure completed in, like, I think it's like 3 months, a couple months. It's definitely less than half a year. And that's the fastest foreclosing state out of all of them. Okay. Some states like New York and New Jersey, which I avoid, you're going to be in foreclosure for over a year. So that's basically having your money or your investor's money tied up for that long while you try and foreclose on the borrower. So I love the faster foreclosing states like Texas. And so there's two options. If this borrower were to stop paying, there's kind of two options in front of me. I can start the foreclosure process, call my attorney, and get them to start the process in Texas. I would use a local attorney in that state, a real estate attorney. And as they're starting that process, I would probably want to reach out to the borrower and just say, look, first of all, what can we do to get you paying again? But if it's not looking good, we could present them with two options. We could say, okay, this obviously isn't working for you. You can't afford this loan. We could either negotiate what's called a deed in lieu of foreclosure, and kind of another way of explaining it is like cash for keys, where they can save having a foreclosure on their credit because we will skip the foreclosure altogether. So it's not going to impact their credit for the next 7 years. And in doing so, we'll give them a little bit of money to cover their moving costs, and they'll essentially deed us the property because we're the lender. They can literally just deed the property over to us as the lender and walk away. Okay. And so we might pay about the same cost as it would to foreclose. We give that money to them to move out, and we'd only give them that money once they've shown that they haven't destroyed the property or poured concrete down the toilet or whatever. But as long as it's in good shape, we'll give them the money to leave. And then what we would do then is now we're the owner of that property. And then we've got all kinds of options, right? We could keep it as a rental. We could owner finance it again and create a new note. We could sell it as is with a realtor. We could fix and flip it, like do a total remodel and then sell it. So there's a lot of options in front of us once we own that property. Okay. But it depends on the situation. They may not go for the deed in lieu or the cash for keys option. And so we may have to foreclose. Okay. And I'll talk about the numbers in a second, but I'll just explain the foreclosure. So in that case, if it goes through to foreclosure, we would be selling it on the first Tuesday of the month. And that's when the foreclosure auctions happen in Texas. And our attorney would go to the courthouse steps and auction off the property to the highest bidder. Okay. And again, as long as it sells for more than is owing on the note, then anything above that amount would go to the property owner, and we would get paid the amount owing on the note. Okay. And then we're done. If no one bids on the property, then at that point it goes back, and now I own the property as an REO, and the lender takes ownership of the property. And then we have all those same options ahead of us, as I mentioned, with the deed in lieu, where we could keep it as a rental or sell it off or whatever. Okay. So before I buy the note, I like to look at these two exit plans as well, just to make sure that I'm not going to lose money. And so here, DIL is deed in lieu. So this is where we get them to deed over the property to us without the foreclosure. And so I just figure, we could probably sell it for about 80% of the value, just for a quick sale. So I'm thinking you could sell it for $80,000. And after paying a realtor to sell it as is, paying to the realtor commissions and closing costs, probably make about $18,000. Okay, so that's pretty good. $18,000 on that. And that's after paying back my investor their interest. All right. So that's exit strategy, I guess, number one, if they don't pay. And then if it were to go into foreclosure, I'm thinking in the mind of an investor, if I'm going to a foreclosure auction, I'm going to want to buy a property at a discount. So I might maybe bid 70% of the value so that I have some equity there to do whatever I'm going to do with the property. So I'm assuming they're going to buy it for 70% of value. Okay. And so let's say it sells for 70,000. And if after I pay my attorney their foreclosure costs, I'm probably going to get about 15 grand there. Okay, so I know now that if my borrower were to stop paying, there's still a way to get my money back and even make a profit on this deal. Okay. And then the other scenario I like to just look at is what happens if the borrower decides that they're tired of paying 12% interest and they want to get, a nice loan with a lender, go to a Wells Fargo or Bank of America, and get a lower interest rate. Well, they can pay us off the full payment amount. And we would make 16,000 in profit there. Okay. Because we bought the note at a discount. And so we would get paid back that 16,000 minus what I would be paying my private lender in interest. So this is my profit if they were to pay us out, say tomorrow. Okay. So those are the kind of 4 exit strategies. They pay us off or refinance. We foreclose. We do a cash for keys deed in lieu of foreclosure, or they just keep paying. And so that's how I run my numbers and try to figure out what my offer price is going to be. So I want to look and make sure my yield's high enough so that I can pay my investor, or if I have my own money in the deal, then I want to make sure the return's acceptable to me. And then I also want to make sure that my exit strategies, I'm not going to lose money if things go wrong with the borrower.
I'll add one more quick exit strategy because you can actually flip them too. So in this case, you're making 17 point whatever percent. And a lot of investors would be very happy with 12, 13, 14% because you can go sell it so that their yield, you sell it at a price that gives them what they need. And then you can keep what's in the middle because that 17.4% or whatever is a very high, healthy return. A lot of people would be happy with less than that. And so imagine you bought it for 50, then you went and sold it to somebody else for 60 or 65. And now you're done with it. You've made your money and you go on and buy another one. But anyway, Michael's got his hand. Go ahead, Michael.
Cal, you had that full payment option where they were refinancing with a lower rate. Do you build in prepayment penalties so they have to pay extra to do that?
Well, when you buy the note, you are taking over whatever the terms of that note originally were with the borrower. So if there was a prepayment penalty built into the original note, then yeah. This one in particular, there is no prepayment penalty. And what I've found is a lot, and correct me if I'm wrong, guys, because I am a Canadian, but what I've found is most of the mortgages I see don't really have those prepayment penalties the way they do in Canada. Like
the US are not as common. US, they tend to make their money on the front end and there's the fees on the front end. In Canada, the banks love to make money off of paying out early and interest differential. And the Canadian banks drive me crazy. So anyway, another reason why I invest in the States.
Yeah. And you get those interest rates are locked in for 30 years. Whereas here, you're only in a 5-year term typically. So
exactly. Yeah.
30-year fix is very common in the US. Which is nice here because it makes it easy to analyze these deals because I know that I'm going to be getting that 12% the entire length of the loan. I don't have to think about, well, what's it going to be when the term's up, if it's an adjustable rate or something. So, yeah.
So I've got a question, Cal. What due diligence is necessary? Obviously, you want to find out the value of the property because that's where your security is. But what do you have to look at title, or is there anything else you need to do to make it a safe investment?
Well, that is a great segue, Mike.
Oh, well, there you go.
I've actually got a slide here. I knew you were going to ask me that question. All right. So the main things that I like to do are, first of all, you need to know what's the value of the asset, right? You don't want to be paying more for the note than the property's worth, because if they stop paying and you got to sell that property off, you're going to lose money. That's number one, right? So we get a broker price opinion. Again, like You could, I guess, do an appraisal, but they're expensive. Usually a broker price opinion is good. It's a little bit more in depth than just a realtor CMA that you would get, because they're looking more at the condition of the property, at least from the outside, instead of not even looking at the house and just, pulling comps based on their computer screen. So we get that to establish value. I always want to do a title search just to make sure that there's nothing on there that could affect me as the lender. So let's say that there's, an IRS lien or something like that. Maybe I'm actually not buying a first lien mortgage. Maybe there's another mortgage in front of me. I want to make sure that I'm buying a first lien in most cases. So we always want to check title, make sure there's no issues in the chain of title that could come haunt us later. Because maybe something with, a deed was recorded incorrectly and my borrower is actually not the actual owner or shouldn't be. So we want to just make sure there's no issues there. Excuse me. We want to check taxes, because even in first lien position, and Mike, you'll know this with tax deeds, even in first lien position as a lender, the one thing that can wipe you out is property taxes. So the county has the right to foreclose out from under you if taxes don't get paid. And so that could be a major risk. So we want to make sure that if the taxes are not paid, we're going to pay them as soon as we buy that note. And so we're probably going to back our bid even lower when we make our offer, because we know we're going to have to factor in the cost of getting the taxes current again. Okay. And then there's something called an external condition report. You can pay for that if you're buying a note that's far from where you live. And that's just someone that can come and take photos of the external condition and just give their two cents on the neighborhood and that kind of thing. Basically be your eyes. You could get a realtor to do that. I've got a company that I work with out of Texas that they offer all of these services in pretty much every state and major market. So it's kind of a one-stop shop where you can get a BPO ordered, a title search ordered. The title search has a tax report in it, and they can also do an external condition report for you. So it's really awesome. You just give them the address and the borrower's name, and they can do the whole thing for you. So that's kind of the external due diligence. And then when you're talking to the note seller, typically they're going to be using what's called a loan servicing company, hopefully, to service the loan. And that's what we're going to use too when we buy the loan. That's probably the most important person on your power team, is having a good loan servicing company. And their job is to collect the payments from the borrower. They're going to be the one that's communicating with the borrower. If there's late payments, they're going to be charging the late fees. They're going to be doing all the bookkeeping, keeping really great records of communication and payment history. So that way you can every month get a statement, you know exactly where your loan's at, if the borrower's been paying on time, how much, principal pay down, all of that. But also it's really important, because if you ever want to sell that note, the new investor is going to want to see all that. Okay. So you want to make sure you have a great loan servicer, but you also want to get that same information from your note seller. And so they're going to have what are called servicing notes, which is a detailed log of all the times they've had to communicate with the borrower, any events that have happened with the borrower. It's also going to have a payment history. So you should be able to see every month that they've paid, if they've missed a payment, if there was late fees charged, like all of that, you can see it in a spreadsheet. And you want to be able to review that just so you can see what kind of the habits the borrower has, right? Are they paying on time every time? Are they sometimes late? Do they miss a lot and then pay a bigger payment? Like you can really get a feel for their patterns, okay? And that helps you decide if you want that note or not. The collateral file, so that is just the deed, and then there's going to be a note, as I mentioned. So you're buying a note, which is kind of like the IOU, and that's going to have all of the terms and conditions, right, that you and the borrower are agreeing to. But then, so that's just kind of the rules of the game. That's what the note is. But you need the security to the house as well. And that, in different states, they call it a different name. But in Texas, it's called a deed of trust. Some states, they just call it a mortgage. And Georgia, they call it a security deed. But what the deed of trust is, or the mortgage document, that's the thing that secures you as the lender to the piece of property and allows you to legally foreclose. So there's actually two pieces of paper that you're getting. You're getting a note and a mortgage, and both of those would be assigned into your name when you buy the note. Okay, so that's part of the collateral file. And then you want to make sure that there's insurance on the property. And you want to make sure that when you buy that note, you're listed as a primary insurer, or usually you're listed as the lender, which is a first loss payee, which means that if that house burns down, you as the lender get paid first, okay, or floods or whatever. So you want to make sure you have that. And then you want to also make sure that taxes and insurance are getting collected out of escrow by the previous lender, and that's going to be paid by the borrower out of their payment. Okay, so that's kind of the due diligence. My basic criteria, I'm always looking for first liens only. I'm not interested in any really rural, remote areas. 10,000 people and less than that, I don't want to be involved in that because it's just too hard to get people out there. If I need realtors or eyes on the property or anything like that, contractors, it's pretty hard in a really rural, remote area. I do avoid some of these states where it makes it really hard to foreclose or evict. So those are some of the states I avoid. Some of them, like West Virginia, is just pretty much all rural. So it's not that it's bad buying a note there, but everything's pretty much remote. Wisconsin has really high taxes. So those are the states.
I might add California to that list. Speaking of places that are hard to evict.
Yeah, that's true. And it's really expensive.
Yeah.
Like buying notes, you got to have $500,000 in California. So
yeah.
And then one rule of thumb is like, don't lend on anything you wouldn't want to own. So, if the numbers look really great on a donkey farm, do you want to own a donkey farm kind of thing, right? So you got to think about that because you may have to foreclose and take that property back. And then I like to see at least 3 months, but preferably 6 or more months of payment history, just to make sure that the borrower can actually afford and are making their payments as well. And then a couple more slides, just more summary. So as I said, you want to have a really good servicing company that's going to service your loan for you. And that is where you outsource all of the brain work and all of the work itself. So once you get the loan purchased and you get everything, all the details fed into your servicing company, they're going to take it from there. They're going to charge you a small fee, like 30 to 50 bucks a month. And they're going to do it all for you. So it's literally at this point, hands off. If the borrower is late and gets to the point where you need to start foreclosure, they're going to let you know and say, look, we should probably start foreclosing because they haven't paid in 3 months or whatever. So they really do all the day-to-day work for you, which makes it really hands off and passive. And they communicate with the borrower. It's all on them, which is great. The other things is just local attorneys and real estate agents just to do some of that due diligence for you. If you need to foreclose, you need an attorney that understands the rules in that state. And then if there's no insurance on the property, forced placed insurance can be put on with you as the lender being protected. So those are some of the people you need on your team. And then the last thing is just finding notes. So I do a lot of networking on LinkedIn. I reach out to, there's so many banks out there. And so I'm constantly looking, if I do a search on LinkedIn for people that are in the special assets department or secondary marketing department at banks, you can literally type in special assets, choose your state, and then it'll give you anyone that has that job position. You can send them a message on LinkedIn that you're looking to buy notes and want to know if they're selling any. I bought these 2 notes from a platform called PaperStack, and it's a buying and selling platform for note investors to buy and sell notes. So there's lots of deals to be had on there. Loan servicing companies will sell notes for their clients. So on their behalf, if it's a large servicing company, they may have lots of notes for sale from their various clients that they're working with. And then just networking with other note investors on LinkedIn or in meetup groups or whatever it is. They may have their own notes that they're selling for various reasons. So that is it. I'm open to questions, or we can shut it down now. But if you're interested in learning more, here's my contact information. I'm happy to chat with you a little bit more on note investing or some of the other stuff we've talked about in the Wolfpack for sure. And I've got lots of videos up on my YouTube channel as well. If you look up Cal Ewing _real estate. So I've got lots of videos on notes and that kind of thing there.
Yeah, excellent presentation. Thanks for sharing that. Let's open it up to the wolf pack. Do you guys have any questions for Cal? I think it was very thorough talking about the due diligence and how to find the notes. And obviously you're open to having other investors who don't want to do any of that work and they just want to team up with you, let you do the work and put in the capital as well, obviously. So cool.
Yeah.
All right. Who's got some questions? Michael does. Go ahead, Michael.
I know, Cal, based on some of your walk to the bus stop videos, that you also buy notes where they're not making payments. Could you explain that and how it differs?
Sure. So yeah, if they're not making payments, those are called non-performing notes. And there's kind of two categories. There's situations where the borrower is not paying, but in the last 6 months to a year, they show signs that they are paying, they're trying. So maybe, they'll pay and there'll be 3 months of no payments, and then maybe they'll pay double. And then, like they're showing effort, like they're trying to make it work. And so those loans are loans where I like to be able to buy the loan and then work with the borrower to try and figure out what's their problem, how can we help them get paying again on a regular basis. And COVID's a really good example, right? Because we've had a lot of people in the last few years that maybe they got laid off, they weren't working, couldn't make their payments, right? They got in a lot of trouble. And so maybe they got behind, but now they're trying to get caught up. Maybe they're working again now, but now they're like, how do I dig myself out of this hole, right? And banks, they don't want non-performing loans. They're in the business of earning interest. They don't want to foreclose. They don't want to take properties back. Their business is collecting interest payments, right? And so a lot of times banks will actually sell these loans at a bigger discount. So instead of paying 70, 80, 90 cents on the dollar or par for a performing note, you can buy non-performing notes for 50, 60, 70 cents on the dollar, okay? So that's category one, is those kind of notes where you can hopefully work with the borrower and you can even modify the loan for them. So let's say they're back to work again, they got a consistent income, but now they owe a year's worth of payments that they're behind. So you might be able to go, okay, Mr. and Mrs. Borrower, we'll put that whole chunk that you owe, that whole year's worth of payments, we'll actually tack that on to the back end of the loan. If you can go on a trial payment plan and show that you can pay consistently for the next 12 months, we'll modify your loan and put that part that you owe at the back so you can just pay it at the end. And so if you can get them and work with them and try to solve their problem, you're allowing them to stay in their house, avoid foreclosure, solve their stress, and then you get the loan paying again, and you bought it at a way steeper discount. So your return on investment should be even higher, okay? And then you've always got those other exits. So if they just can't get going on track again, then you can always foreclose or do the cash for keys deed in lieu of foreclosure and do it that way. So you've always got that as your part of your exit plan on those notes. Now, so that's the situation where you're in contact with the borrower and they're trying. You're also going to see loans where the house might be vacant and they haven't paid for a year, 2, 3, 4, 5, however many years, or maybe they're living in the house, but for whatever reason, the lender just hasn't foreclosed on them yet, and they haven't been making any payments. There's no sign of them trying at all. And so those situations, you might be more just looking at buying it and foreclosing, okay? So you're looking at what are your foreclosure numbers going to be? How much can you sell that for at the foreclosure auction? And you just want to buy it at a low enough price so that when you foreclose, you're going to get your money back plus a nice return, and you just handle the foreclosure. Okay. So, and your goal may be to actually own that property. So sometimes there's situations where, let's say the house is worth 100,000, the borrower owes 120, right? In late fees and everything they owe on that loan, 120. So your goal might be to buy that note, foreclose, and you know that no investor is going to pay 120 for a house that's worth 100, right? But that's okay. If you bought that loan at 70, right? It doesn't matter. So no one's going to come and bid. You're going to start your bidding at 120, and no investor is going to buy it because they're going to say, I'm not an idiot. I'm not paying 120 for a house worth 100. And now you're the owner of the property. And now you can keep it as a rental, fix and flip it, whatever you want to do. You now own that piece of property if it's a good property. So it's a way of actually acquiring assets. that's your strategy. Yeah. Good questions.
Great question.
Yeah.
Any other great questions or even mediocre questions are acceptable at this point?
Even crappy questions, I'm happy to
Even
answer.
crappy, but we'll take whatever questions you got. We're good with all of them. There's no such thing as crappy questions.
No, there's not.
Well, but we will take questions from dogs even. So, everybody's equal opportunity.
Yeah.
All right. I'm going to give him last call going once. Michael, go ahead.
What are the typical values of the notes that you're buying? Are they usually around, 100, 120, 150, or is there quite a range? Just depends on the deal.
Well, you could buy, I've had lists from banks where all the notes are like in the millions. So if you're that kind of investor, great. I've also had lists from banks and servicing companies where the loan purchase price is like in 30,000, 20,000. I saw one yesterday on PaperStack. I don't really understand it. There's $1,000 owed. And the seller, the comments on the description of the note says, here's a great entryway to learn the foreclosure process. And there's $1,000 owed. So you could go and foreclose on that house, I guess. I just skipped over it. But so there you go, $1,000 all the way to the millions. But me personally, and this is advice that was given to me, I haven't encountered it, but I like to stay, at the 300,000 and below range. I've been told by other note investors that when you start playing in the more expensive notes, the borrowers have the ability to pay attorneys to drag on foreclosure, right? If you've got $1 million house, you can probably afford to just keep paying your attorney to drag on the foreclosure and drag it and drag it and drag it and drag it while you get to live in your house without making any mortgage payments for 5 years, right? So the advice I was given was stay away from those high-end properties where the foreclosure could get drawn out. Stick to the kind of the, like the mid-level properties in your market where, just like the working class type borrower buyer, where they can't afford to stretch you out for years and years on end with foreclosure costs with attorneys and stuff. So plus it's easier to raise capital when you're, 100,000 and below than millions.
Great question. Anybody else? Going once, going twice. All right, Cal, thanks so much for spending a Saturday morning with us.
You
So
bet.
it was great information as always. And if anybody has more questions, reach out to Cal. He's very, very knowledgeable and very honest and somebody you can trust. So I hope you all have an awesome weekend. And we will talk to you all. I think we have something on. No, actually, by the way, this Tuesday, we don't have an event because Julie's going to be busy. But and this Wednesday, I don't think. Anyway, check your calendar because I know we have something coming up, but I can't remember what. But anyway, have a great weekend, everyone. Thanks again, Cal. And we'll see you all soon.
Thanks,
See you guys.
Cal.
Thanks for
Thanks, Mike.
attending.
Take care,
Yeah.
everyone.